Hey, this is Ewan here from the2traders.com. I'm going to be covering stop losses in this video, so why they're so important and how to place them. So I'm going to go through two placement methods in this video, and there'll be a follow-up one with two other methods just to break up a little bit. So stop losses are crucial because they define your risk to reward. So you'll see a lot of new traders who start trading without stop loss, and what happens is the market moves away from them and they don't have an exit strategy. And what this means is the loss gets bigger and bigger until it's too late and they don't know how to exit the position, and it just destroys their account. And that's why stop loss is so crucial. But you also need to understand how to place them. So on the flip side, some newbies place stop losses too tight, and that means that they get stopped up by very small market moves, and then they miss the profitable opportunities. So you've got to find a sweet spot in the middle. If you stop too tight, you don't give the market enough space, but if it's too wide, you ruin your risk to reward because the market's moving too far away from you before you close out your position and admit you were wrong, and that means you're giving up too much of the market distance. And when you do make a profit, then your risk was too big to begin with, and your profits kind of diminished from then on. So just going to go through a couple of examples, and that's the best way to do these things. So here we've got Euro USD on the daily time frame. So the first method I'm going to talk about is our favorite, and what it is an ATR method. So we've done a separate guide on ATR and how it works, and it explains it in a lot more detail, but for the purpose of this video, all you need to know is it's an indicator of the volatility. So this works as an excellent stop loss method because it allows you to adjust your risk based on the market conditions. So when it's less volatile, as you can see in this area here, the market's not moving a huge amount, the ATR is a lot lower. And when it is very volatile, so this kind of spiky region up here, and there's another example I'm going to go through on the right hand side here, then your stop loss is going to be a bit wider. And that means you're less likely to get stopped out in volatile conditions. So we've just got this example here, and we've just used this kind of random breakdown as an entry. It's not really following any system, it's more for the purposes of this showing how the ATR stop loss works. So what we do with the ATR stop loss method is we multiply the ATR by a factor, and this allows our stop loss going to be a little bit wider than one ATR, and we can adjust the number of the factor we multiply by to get a wider stop loss. So you can see here with the closes at 1.3751, and if you can look in the bottom left where I'm circling now, the ATR is 0.0059. So two ATRs here is up to 1.3868, and four ATRs is obviously twice as far, and it's a 1.399. So just for the purposes of this, just show you kind of how big a difference having an ATR or two ATRs can be. So two ATRs here is plenty of room, it gives the market lots of space. But if you make the ATR too big, you can see it's actually very far away. And what happens is, if this is too far away, I'll show you here, you've got this risk to reward here. So if the market moves all the way to this green point here, which it does, our risk to reward is actually 4 if we're using a 2 ATR stop loss. Now, if we're using a 4 ATR stop loss, our risk to reward actually goes down to 2. That should be 2, but I'm not doing it exactly here. So by having a really wide stop loss, what happens is our risk to reward is halved because we've doubled our stop loss, and that means when the market does go our way, it's too wide. On the other hand, if we had a really tight stop loss, the chances are we could have got stopped out here, and then we missed the move entirely. So there's a sweet spot of a factor between 1.5 and 2, and if you can have your ATR in that spot, it's a balance between having a stop loss very wide and having a nice tight stop loss for a good risk to reward. I've got another example down here to show you how the volatility affects the actual ATR. So you can see here the ATR is very low, and we get a good stop loss, which means this position will be actually incredibly profitable because you get a really nice tight stop loss because it's not very volatile and the move's really big. Whereas here you can see it's a lot choppier, and if you entered again, I just chose a random bar here, but look how wide this 4 ATR stop loss is. The 2 again is pretty nice. It's just enough room to let the market move around a little bit, but it's not so much that your risk to reward is getting compromised, and it's not too tight that if you had a 1 ATR stop loss, which would maybe be down probably about here, we actually get stopped out in this region here, and that means we'd miss this whole move down, which again is an incredibly profitable period for Euro USD. This was in 2014-2015. So this is our favorite method, and that's just because it allows you to position your risk and scale your risk according to market volatility. So less volatile conditions and you get a really nice clean breakout, you're going to make a lot of money from those. And if it's very volatile, you're not going to get stopped out as easily, and again, that's a very good feature of this stop loss method. So I just want to show you how this looks on small time frames. because the issue is as you move to small time frames, the spreads become more significant compared to the ATR. So if you're using the ATR method, you can actually end up with really tight stop losses, especially when you account for the fact that you can open a position a few pips away because of your spread. So this is a 15-minute again for Euro USD, and if you enter on this this red bar here, it actually gets stopped out straight away, and that's because the ATR's only 0.006, so that's about 6 pips, which is only 3 times the spread. So you're actually getting a very, very tight stop loss, and you're going to get stopped out very frequently. So brings us neatly onto our second method, which we prefer for short time frames, and that's the number of spreads. Very similarly to the ATR method, number of spreads accounts for market liquidity and volatility, because less liquid and more volatile markets will naturally have a wider spread. If you look at the yen positions, if you look at CAD JPY, you typically get about 6 pips on that, compared to Euro USD, where you might even get 2 or 3. Or with some brokers, you might even get a 1 pip spread. But so if you're working on short time frames, the method we like to use is just a fixed number of pips, or a fixed number of spreads. So for this example, we could say we'd multiply them by 10 spreads. So we'd use 2 pips times by 10, and that gives us a 20 pip stop loss. So if we look at it here, we're at 1.1427, so our stop loss would actually be up at 1.1447 here. So that's just it's a very similar example to the ATR method on the daily time frame, but rather than using the ATR, we just use a number of spreads, and you're going to have to use a wider factor for that. But the important thing about these is that you're consistent. So if you're going to be using 2 ATRs, use 2 ATRs in every position, because what you don't want to be doing is using 1 ATR in one position, 5 ATRs in another position, and then the one that you use a small ATRs on actually a loser, and then the one that you use the big ATRs on a winner, and your risk reward's completely gone because your big position was actually on a very small risk, and then your losing position was on a very tight stop. So make sure you're consistent with the method you use, and make sure you're consistent with the width of stop loss you use, because the beauty about the ATR is it's going to be market specific anyway. So you can use factor of 2 for every market, and more volatile markets like oil will have a wider ATR naturally, so you don't really need to worry about what market in, because it's a nice universal method. So I hope you have a better understanding of how you can use volatility to determine your risk, and how you can adapt it very slightly just based on your different time frames. And you can always visually gauge if your stop loss is too close or too far, because imagine I end up with a stop loss down here. We know pretty quickly that it moves this distance in a single bar, and that's obviously too tight, because this is a 50-minute chart. 50 minutes later, your position's already stopped out. You're clearly doing something too tight. And again, if you're putting a stop loss way up here, then there's no need to have it this wide. If the market moves all the way up above this level, you're not going to want to be in that position anyway. So that will already be an exit signal to get out. So there are another 2 stop loss methods that we'll go through in the next video. But make sure if you drop us a comment and ask us if you've got any questions. Thanks a lot, and make sure you check out the next video.